best value. You can get it from any of the branded jewelers also. So it's just, now it's on the play of design, the play of offer, and the play of relationship. So that is, I think, at overall level, we are working on.
So if we build on this same store sales growth story, and what we've said is that almost 75 to 80% of our total growth is coming from the existing store, that is a triple SG. Because our average sale per store is still less than 100 crores. So we have certain stores which have reached 100 crores potential. So till the time each and every store reaches the 100 crore potential, that means 155 stores, 100 crores, 15,000 crores. So till the time that sort of base is not achieved, we will continue to have a major growth coming from the existing stores. So that story will remain intact for next 3 to 4 years. That's what we believe.
That's helpful, Mr. Banka. Just one follow-up here. Do you see a starkly different competition angle in the north versus south during this quarter 3?
Quarter 3 or quarter 4?
This quarter, you think quarter 4?
No, quarter 3, when I'm saying, do you see a competition is becoming more hyper in the south than north, or it is equal?
Okay. No, so the competition in south has always, it's been a highly competitive market. And as a result, we want to continue to focus on our growth on the eastern and the northern part of the country. And in north, maybe the competition is not as high as south, but the competition surely exists. And we have to all the organized players are endeavoring and striving to take the share of the market from the unorganized. So that's the journey that everyone is doing. And I guess everyone is looking at the coming 10 years, 15 years, rather than just a year or 2 years. So everyone looking long term and wanting to acquire customers.
And moreover, Shirish, if we look at our presence in south, we have only 5 stores. I think 3 in Hyderabad and 2 in Bangalore. So our presence and exposure in south is not very high. That is point 1. And south, we know, is a quite competitive market. But since our base is low, we are not at competition to the south players. So we continue to have a different altogether. And we feel that for us, there is ample opportunity to grow. So even in the YTD basis in south, we have grown by 31%. That's against the national growth of 26%. That's how we look our core market now and our core customers even in south.
Okay, that's really helpful. And that's why my second question is that if things are going right, would you track or would you have any number handy that what is the new buyer contribution into the growth, or maybe new buyer contribution if you have a number?
New buyer contribution into the growth. So I'll give you a broad number. The broad number is that suppose X number of transactions we are having for the year, which is around in the range of 5.5 to 6 lakhs. And out of that, around 2 lakhs is the new buyers that are added to the kitty. So that comes to around 35.
These are almost out of almost 45. So what we said earlier, the 45 to 50% are the new buyers. Are the people?
Yeah, on 40%.
Yeah,
40% are the new buyers, and 60% are your repeat buyers who are already there existing in your system. So this is how we are looking at the overall number. So which is a good sign, because as much as you are worried and concerned, and we are as well in driving that we need to acquire new customers so that the growth continues to happen in the future. So this is how it is.
Okay. Shivankar, that's helpful. My last question. In our core market, during the IPO meet, we had mentioned that we want to increase the ticket size. So when you compare last year quarter 3 versus this year quarter 3 in the West Bengal market, is there any ticket size growth, or the growth actually has come, and what is the number?
The ticket size growth, let's say, I don't have the exact number comparative. So basically, ticket size, last time we had shown around 45,000 average pan-India and 65,000 ATV. So versus last quarter to this quarter, it has not grown. But what we saw, there was a major shift versus last year to current year by almost from 35 to 45 we have moved, and that we have indicated in our earnings call presentation also, which was indicative of premiumization, but not in the current quarter. So versus last quarter, this quarter, it has not moved, but earlier year to H1, it has moved.
So the ticket size quarter to quarter hasn't moved, but because of the gold price increase that has happened in this particular financial year, so the average ticket size has grown up by 15 to 17%. So from approximately 45,000-50,000 rupees, it has moved up to around 60-odd thousand rupees. So that has been the movement of ticket size growth.
Right. Thank you, and all the best to you, sir.
Thank you. Thank you, sir. So let me again, I would like to share that, because we have our growth analysis in terms of volume as well as in terms of value. So be it in gold or in diamonds. Now, while we can say that, we have grown by 26%, but to what we understand is that the value growth has been around 16-17%, while the volume growth has been around 9-10%. And the volume growth for diamond has been 27% and a value growth of 40%, and a value growth of gold has been around 9-10% and a volume growth of 3-4%. So this is where we can see that the overall aspect has worked on.
Thank you.
Kindly allow me to rephrase it. The gold volume growth has been around 9%, 8 to 9%. So out of total 26% growth, we can look at 2-3 angles. How much is SSG and how much is existing? So we say 17% SSG, 8 to 9% new store. That is one angle. Second, we look at gold and diamond. So we say diamond 12%, gold 86%. Third, we look at volume growth and price growth. So versus last year, YOY, when we look at 26%, there has been a 15% price growth. Which means there is 9% volume growth. So in gold, I repeat, out of 26%, 9% volume growth, 26% overall growth, that means 9 plus 17. That is one. And since 26 is a sum total of gold and diamond both, so it is not exactly fully mathematically, but diamond is around 27% volume growth and 41% value growth. So both of these taken together contribute to 26% growth.
Yeah. My mistake, I said 3% volume growth. What Pankaj is saying is the volume growth in gold is around 9%.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Pallavi Deshpande from Samiksha Capital. Please go ahead.
Yeah. Thank you, sir, for taking my question. Just wanted to understand on the expansion for next year, FY25, how many would be franchisee stores and how many would be the owned stores? And second would be, what would be the sales per store in the south?
Right, ma'am. So, ma'am, in terms of expansion, while we want to open around 18 to 20 stores, our endeavor would be to open 9 to 10 company-owned, company-operated store and 9 to 10 franchisees. So that is what, in all our future growth, we want to open equal number of franchisee and own store, because that will continue to ensure that our return on capital continues to remain robust. However, as we saw in this financial year, when there are these sudden jumps in gold prices, the franchisee partners also takes a little bit of time to get adjusted to the price and then plan for the investment. But that is our plan. And when it comes to the average sales for the southern stores,
Average sales?
Average store sales.
Average store sale for South is around
27 to 30 crores. These are average sale. And you are aware, ma'am, that in South we are aware, there are so many retailers and they are doing very close to 100 crores of sales. So the opportunity of growth in the future is very much there, and that is where we see a higher percentage of growth as well happening from southern India, and that is what our effort will be to striving to grow more and more. However, we continue to be a niche player in South because East and North will be our focus. South will be where we will have stores. We will build up the store. We will try to maximize it. Competition is high in southern India, but so is the plan around it.
Just to add here, when we are giving the average South store, so out of 5, 3 are old and 2 are new. So for the old stores, they have achieved maturity. They are break even at the OpEx level and also at the inventory level. So every store, it will dilute the average store. So South stores are break even and they are contributing to the bottom line as well. And that's why when we are seeing the maturity of the existing stores, we've opened 2 more stores in South.
Right. And from the inventory part, how do we see it for the March year-end? That does it stay? I mean, do we factor in this 400 crore for the year itself increase?
So inventory value, as you said, that inventory, the total inventory as against March 23 has increased, right, by around 300 to 400 kg. So it is gold and diamond both. But what is more important is the inventory turnover. Inventory turnover, which we have earlier indicated. So there is some revision in the representation. So it is below 150 days. So inventory days is below 150 days, and that's why we feel that our inventory turnover is among the best in the industry.
Right, sir. So just lastly, what would be the capex number for next year? We can build in, like you said, only half would be the own store.
You are looking at a capex for the next year, right?
Right.
So basically, when we talk about 15 new stores, as we are now looking at the new store format, that is the modern and the classic format. So let's say 10 to 15 new stores, they will cost, the capex will be at least around 35 to 40 crores. So that is one of the major capex. And since we are focused on IT, as we said that we are a highly tech-driven organization, we have launched beta hours. Our IT systems, our entire systems on IT. So we will continue to invest in IT as well. So then some of the stores we can procure. So we can say around 60 to 70 crore can be the capex plan for the next year. 55 to 65.
55 to 65.
55 to 65, and we have adequate free cash flow for that. So the future growth, as you say, all our future growth requirement for the capex and for the inventory and for the margins for working capital will be funded from the internal accrual and the borrowing. So we have consistently maintained that a sustainable level of the debt equity ratio for the next 3 to 4 years will be 1.2 to 1.25.
Right.
Because our blended borrowing cost is lesser. Since the blended borrowing cost is lesser, so we have to deliver a ROCE of around 15% and return on equity of around 18-19% for the existing stores. At blended level, obviously, when you add a new store, it will optically dilute the overall blended ROCE and ROE. But existing stores will continue to deliver, existing portfolio, I mean, that will continue to deliver at least 19 to 20% ROE and 15 to 16% ROCE.
Right, sir. Thank you so much, sir.
Thank you. Next question is from the line of Vidisha Seth from Ambit Capital. Please go ahead.
Yeah, thanks. So just two more questions from my side. Do you think our current making charges are at par with the industry, or is there more scope to get more competitive in order to gain market share, especially in newer regions like North?
So Vidisha, see, the point is ultimately for the industry, the making charges is where you are earning your margins, and that is where, our gross margins for our company-owned, company-operated stores with a blended way, maybe gold and diamond put together, is in the range of, say, 16, 17, 18%. Now, product to product, because we are focusing more on handcrafted jewelry, that is one. We are confident that, say, we are wanting to develop designs that are selective and something that the consumers can buy. And, the balance between achieving growth and achieving profitability. And also with more and more of our stud ratio going up, we will be able to leverage margins from the studded category and then, pass on that benefit of the profit from studded category by becoming more competitive in the gold category. So the options are there. But at the same time, you can reduce your making charges. But what happens when you want to give offers and discounts, and that is an expectation of the consumer. So you have to be very, sure on what is that optimum price, and when the customer will come and ask for some special offer or offers are across the year, then what discounts you can give. So maybe 1% here and there is an opportunity, and we are keeping a close watch on the market and accordingly optimizing the making charges.
Fairly clear. And the second was on the lab-grown diamond bit. What makes you confident that value cannibalization of the current natural studded portfolio won't happen? I understand that the customer profile or the occasion could be different, but given that Senco has been able to attract consumers with the proposition of low ticket prices low ticket prices, is there not a scope for these sales getting transferred to the LGD offering? That's where I was coming from. And also, have you worked out on the buyback bit given the moderating prices of lab grown?
Yes. So there is a buyback policy for the lab grown because, in order to make anything a success, and especially the mood and the behavior of the Indian consumer, they would treat jewelry not only as an adornment but also as an investment. So to win the trust and giving them the confidence of the consumer, you need to have a buyback for your product that you sell. So that is very much in place. And when it comes to the opportunity of lab grown, it all depends on the kind of products that you are producing and what you want to sell to the consumer. So at the everyday wear, lightweight jewelry, when there is a lot of fashion and lot of design element associated with it, then your small size diamonds becomes a major factor to create unique designs. But when it comes to lab grown, then what really will add value to the customer is the size of the diamond, where you can see much higher benefits. So there would be certain design differentiation. Ultimately, the ticket size is very critical. And while I wouldn't be able to disclose too much on the strategy, but we will make sure, and what our thought is that through design, we will differentiate between natural diamonds and lab grown.
So just one clarification on the buyback bit. So the buyback would be at existing prices or the prior prices? Because since the prices have been correcting, if we give the buyback at existing prices, won't Senco be incurring losses?
So the buyback will be on the current prices. So it will be 80% value on the. So in the future, if the prices go up, then the customer will benefit out of it. If the prices go down, then it will be a loss to the consumer. So it is not at the price at which you're selling, but at the price at which the customer will be there to exchange or to sell. You get it? So that is how we are making it.
Okay. Thank you.
Thank you. Next question is from the line of Rohit from HRP Capital. Please go ahead.
Yeah, thanks for the opportunity. So what is the revenue mix from COCO and franchise store for this quarter versus this?
Your voice is not clear, Rohit. Can you kindly speak query again?
Yeah, so what is the revenue mix for COCO and franchise stores during this quarter versus this?
65-35. 65-35 the revenue mix for company-owned and franchise stores.
Okay. And sir, where there was any hedging gain included at the gross margin or EBITDA level?
So what we are saying is that, no, we don't want to answer this question very specifically. We are following the Ind AS accounting, right? In the Ind AS accounting, which is derivative of the IFRS, the hedging gains and losses are adjusted to the inventory. And since they are adjusted to the inventory, they will be impacting the gross margin. So if there is a price rise, there will be hedging loss and vice versa, which will be impacted in the gross margin. So net, the impact of Ind AS is to nullify the impact of gain and loss. We are fully hedged, which we have maintained regularly, and we are more than 90% hedged for the last quarter. So technically, from a business perspective, we are not a hedge fund. We don't make money from keeping the exposure open. So to that extent, from corporate governance perspective, we are almost hedged when we say 90% hedged. But yes, Ind AS accounting is a regulatory framework which we have to follow.
Okay, so what 90% inventory is hedged?
Yes, 90% of the inventory is hedged. That we confirm again.
Okay, sir. On store addition, during last quarter call, you mentioned that for the remaining financial year, you will have 8 to 10 stores on the base of 153 stores. But in the recent management interview, it was 3 to 4 stores will be added in Q4 on the base of 154 stores. So, any reason for reduction in store addition guidance?
So the store addition is a factor of company-owned store and franchisee. So because we have only added 4 franchisee store, and we could add the rest as a company-owned, company-operated store, and certain franchisees opening got postponed to the next financial year or the next quarter. So we are reducing the guidance on the store openings.
Okay, thank you, sir. That's all from my side.
Thank you. Next question is from the line of Vinod, an individual investor. Please go ahead.
Hi, sir. I have 2-3 questions on the growth. First, you have about 90 stores in West Bengal alone. Any sense how many more you can open in the next, say, 3 years?
Yes, we've done our analysis, and we believe that we can minimum open 10 to 12 more stores, if not more, because it is not only the stores that you open in the bigger cities, it is also the stores that you open in the tier 2, 3, 4 markets. And, because of our franchisee model, even in the smaller towns, there have been small markets and there have been unorganized small, size players. Now with government making hallmarking more mandatory, the supply chain, the sourcing for those jewelers are getting a little more difficult. So everyone is looking for an opportunity. Maybe the existing, any kind of businessman in that particular town. So we can minimum add 10 to 12, if not more.
This is 10 to 12 per annum or cumulative over 3 years?
No, 10. I would say over 2 years, 10 to 12. Maybe over 3 years, it could go up to 15 plus also. But let's keep it at 10 to 12, and per annum it could be 5, 6 minimum.
So, and now looking at the broader East, what would be your market share in the East overall jewelry market today, and what was it 3 years back?
So see, market share is something that, the numbers are not really, out in the open. It is all based on estimation. So number of stores are something that is, the numbers are very much clear and evident. The rest is that where I guess all of us have to understand that what the other players are selling. If the total market is 7 lakh crore industry, 15% of that, which is 1 lakh crore, is your East industry size. And out of that, assuming that 40 to 50% is your organized segment, that is around 40 to 50,000 crore. And then you need to analyze that how much is the share of our other jewelers where the data is out in the public or from East, and then our business from the East is around 70 to 80% of our overall turnover. So then I guess you will get some idea that we maybe hold around 3% or 5, maybe 10% of the organized segment and 3 to 4% of the overall market. This is our estimate, but the numbers again is all one has to do much more analysis to come to the correct figure.
Understand. And with the limitations on data that we have, and I believe you are best placed compared to us, you said 3 to 4% of the overall East market. Any sense, based upon estimates as handicapped as they are, what was that number like, say, 3 years or 5 years back against this 4% now?
So one thing you must keep in mind is that the industry hasn't grown much over the last 4-5 years, right? In terms of value, it has grown, but in terms of volume, the imports into the country has been in the range of 600 to 700 tons on an average, right? So, and there is a steady shift that is happening from the unorganized to organized in a pretty big way. Again, these are all estimates. So if today we are at 3 to 4% of the market, I would say that maybe we've been growing 20% minimum year on year over the last 4-5 years, right? So that means that we've almost doubled. And so you could say it was 2.5% maybe 4-5 years back. So these are again, I'm just giving an answer based on the estimates.
Right. But I'm just circling back to the older question on the stores you could open in Bengal. You said 5 to 6 per annum. Fair to presume that you have already sort of earmarked the places that you want to open the stores, not necessarily zero on the location, but the cities or the micro market you want to be in, and therefore you have greater visibility on the locations?
Yes, so we won't be able to share the details of the location, but we are more or less studying the market deeply. And it is not just Bengal. We are doing it for the markets in eastern part of the country because strategically we want to focus on East, that is where our core competence is, and North as the future market potential. So we have got a whole list of locations lined up, and based on the opportunities, we will always try to grow there accordingly.
So, I asked this question just to play a devil's advocate here that, you have a strong presence in East. One could always question that what after East? If Bengal is, which is where you have...
So Bengal is only one state. Then you have 4-5 more states in East. So your 1-2 year journey, say 2 years journey in a particular state, and then you become the market leader and you capture more from the unorganized. Just as a flow. Then you are focusing on the 5-6 other states of Eastern India. Parallelly, you are putting your base. So we believe in the hub and spoke model. So we've been there in North. We will then start penetrating into the various states. We have already penetrated with more than 20 stores in North India. So then the brand gets stronger and stronger, and we will penetrate in the North India. And then, maybe that itself is a 3-4 year journey. Then is your journey into Central and West, and then last will be, in the South, because South is a highly competitive market. So this is the journey that we see over the next 5 to 10 years.
So, sir, if I can build on that. So when we talk about East, out of all the stores, we talk about Bengal, our stores in Bengal are 90, right? And East is 27, that is 117. So when we talk about this, we have got Bihar, Jharkhand, Odisha, Assam, Tripura, right? So we have store in Tripura also. Chhattisgarh. So Chhattisgarh we are taking FBCG. So there is huge scope in this